Hello and welcome to AllGen's Market Update. Today is November 14th, 2019. My name is Jason Martin. I'm the Chief Investment Officer of AllGen, and I wanted to bring you guys up to speed on the market over the last month. So let's take a look here. A couple of big highlights that we're going to go through. The S&P 500 reaches an all-time high. The GDP went below 2% and potentially could go lower. Sentiment indicators are overly confident, and the Fed cuts the rates for a third time, but could pause going forward. So let's hop right in and take a look at each one of these. So the S&P 500 reached an all-time new high, and we're looking at a chart that I reference quite often that is looking at negative divergences here. So this goes back all the way to 1985. So the S&P hitting a new high is only this little blip here at the very end. But this is something I've been referencing quite a bit, that while the S&P 500 has hit a new all-time high, it's doing it with very little conviction, and that hasn't changed. So I just wanted to bring this up again to show that typically when the market is hitting new highs, you're going to have your momentum indicator called the RSI here that we're looking at also hit all-time highs, or at least hit higher highs. So if you see here in 1986, before the crash of 1987, the market hit a higher high right here, and then the RSI made a lower high. That's a negative divergence. That's a bad sign. So you had the same thing occur prior to 2000. You had the same thing occur prior to 2008. And now we have that same setup playing out. So something that we're eyeing, even though the S&P 500 hit new highs, it still did so with not much conviction. So something to watch for. And then let's take a look here. So this is a chart of the GDP, and it's showing which is the gross domestic product. It measures the growth of the U.S. economy. And typically in a really strong time, you have GDP growing at about 3% plus. So this is quarter by quarter. And you can see here to start off the year, the first quarter was a little bit over 3%. That was good. It was a bounce back from the really slow fourth quarter of last year, which was almost 1%. But then you can see here we've steadily slowed. In the second quarter, we were right at 2%. Right now, we're right at about 1.8%. And actually there is, which you don't see on the fourth quarter here, but there is a prediction by the Atlanta Fed called the Atlanta GDP Now that is predicting that the GDP will be at 1% for the fourth quarter, which would be a similar drop in the economy as we had in the fourth quarter of last year. So this is something that we've been eyeing quite a bit because we've been talking about the inverted yield curve, how that's a predictor of recessions. It gave that signal in March of this year, and usually it gives a signal 11 months prior to the economy actually going into a recession. And the 11-month time frame would be around February of next year. So again, we don't know, no one knows if we're going to go into a recession, but there are a lot of things that are indicating an economic slowdown. So it's something that we're watching closely. And this is something that I often point out, especially when it's at extremes, and it just so happens to be at an extreme for this video, so I figured I'd point it out again. But this is the S&P 500 up top, okay, looking back over the last 2 years. And down below here you have the smart money, dumb money confidence index. And again, this is not our terminology. It's not meant to be condescending. It's put out by Sentiment Trader, but it's measuring the smart money, which is the people in the know, the pension fund money managers, the hedge fund money managers, the people that really, it's their profession, they're at the top of their game. And then the red line here is the kind of average everyday investor who is just kind of going off of a whim or doesn't really, kind of a hobby for them. So the theory goes, as the dumb money is reaching an overly confident level, that's a bad sign, and as the smart money is reaching an overly pessimistic level or lacking a lot of confidence, that would be a bad sign. And when both of them are happening at the same time, like we are right now, that would mean that the sentiment is pointing to the market dropping, or market being too high. I mean, when the market gets overly complacent, when sentiment gets overly complacent, that means the market does not fear it means sentiment is not, people are not fearing the market dropping. Okay, and when you don't fear the market dropping, that means that you've already invested all your money. I mean, if you had no fear that the market was dropping, you'd probably already invest all your money. And if you've already invested all your money, there's not as much cash on the sidelines, which means there's a lot of potential sellers, not too many buyers, and that's why the sentiment works like that. So that's the scenario we're in now. Some people like to call it frothy, but the sentiment is at an overly confident level right now, which could point to a potential top in the market. And then one thing I wanted to point out that's shifted a bit since the last time that we met, that the Federal Reserve lowered interest rates for a third time this year. They've now lowered it by 0.75% for the year. However, it looks like they're going to pause and they're not going to lower interest rates, at least for the foreseeable future. What we're looking at here is it's the Fed Watch tool that gives probabilities of future Fed rates. And so I'm looking at the April of 2020. So that's approximately 4 or 5 months from now, and we're looking at where interest rates should be at that time. And right now there's a 2/3 chance that the Federal Reserve will keep interest rates where they currently are. So that's something for us to keep a watch out for, because we have been increasing bonds, and especially long-term bonds, and those positions have done really well. But if the Federal Reserve starts to pause the interest rate decreases, and potentially even in the future start to raise them, then we need to adjust that position. But we're not there yet, so it's something that we're closely monitoring. So to sum things up, right now we're maintaining a defensive posture. There has been a lot of, the market has been going up. We understand that, and actually we're really pleased, because even though we're in a defensive posture, our accounts for the most part have kept up with the market on its way up. We're only lagging it by a small percentage in most of our accounts, and for doing that in a very defensive posture is a good thing, because it means if the market does take a hit, we should hold up much better. But there's all the talk of China and the U.S. getting a trade deal, or at least phase 1 of the trade deal. I think that has caused the market to go up and already kind of factor in a trade deal happening. And I think the market is a little bit overly confident that it's going to continue to go up. So and there's been a lot of signs like the inverted yield curve that would show that a potential recession coming. Manufacturing globally has really slowed down. Some countries are already in a recession in Europe. So there's a lot of signs that would at least point for us to be, in order to be prudent, to maintain a defensive posture. We're always watching out for things to see if that's going to change in the future, but anytime you have about a 50% chance that the market is going to take a hit and the economy is going to slow down, it's usually wise to be defensive. And so we're maintaining our defensive posture right now as we go into the end of 2019. So what that means is less stocks, more bonds, and we've actually, as I mentioned in our last webinar, increased gold and silver as a play to kind of protect in case we go into a weakening currency environment. So I hope this helps. If you have any questions, give us a call, and we'll see you soon.